Hello everyone, welcome to the fourth part of chapter number 1. In this video, we are going to cover the last areas of chapter number 1. So let's start from where we have left, value for money. Now, if you come to the page number 13, we have got the last topic of chapter number 1, that is value for money. Now, value for money can be defined as getting the best possible combination of services from the least resources, which means maximizing the benefit for the lowest possible cost. This implies getting the most done effectively and with quality with the minimum cost and resources. That thing is called value for money. It basically is also used as an assessment for not-for-profit organization and also the government organization where their main focus is not the profit but the welfare of the people. It basically involves the application of effectiveness, efficiency, and economy. Let's look at them in turn. Firstly, we have got effectiveness, which is the extent to which declared objectives or goals are met. It means the purpose for which the project is started or the investment has been done or the fund is made available. How much of that purpose is achieved by doing the project. That's called effectiveness. Then we've got efficiency is the relationship between inputs and outputs. It basically involves most things done with the least input of resources, getting the most products out with the least input of resources. That is efficiency. It's like the dedicated time of an assignment was, for example, 10 hours, and you have completed the same assignment with the same required quality in 6 hours. So we have got an efficiency over here of 4 hours. That's from 10 to 6. Then we've got economy, which is attaining the appropriate quantity and quality of inputs at the lowest cost to achieve a certain level of outputs. Now that we know that this is the output that we desire and this is the quality that we desire of the output, so instead of reducing the output, we focus on the cost of the input. Here we are talking about mainly from the cost perspective. So the least cost incurred in producing those outputs means that the project was economic. So effectiveness is basically the percentage of achievement of goal. Efficiency is the percentage of achievement of resources, and economy is the percentage of achievement of outputs with the least amount of cost. So that's value for money. Moving on to our example, as promised, you need to come on chapter number 1, page 4, I think. Yeah, that's page 4. Okay, here we have our first example. The following information relates to Henry & Co. Most of my examples are with the same name, Henry & Co. For the last financial year, revenue was 200 million, asset turnover was 10 times, interest payable was 1.5 million, interest cover ratio was 5 times. What is the return on capital employed for Henry & Co. for the year? Now, if you look at the data, we are to compute return on capital employed or ROCE. For this purpose, we need, as we have already know, if you look at the formula above, is profit before interest and tax divided by capital employed. Neither we are given profit before interest and tax, nor we are given capital employed. So how are we going to solve this? We will solve that via other ratios. Let's come downstairs. Yeah, come down a bit, not stairs. Okay, Now we need to compute ROS. ROS is profit before interest and tax divided by capital employed. Now in order to compute profit before interest and tax, let's see what we are given. We are given with the interest cover, interest payable. Let's compute that, use that to compute profit before interest tax. If you remember, interest cover is equals to profit before interest and tax divided by finance cost or interest cost. In this case, we are given with an interest cover of let's just look at that. We are given with the interest cover of 5 times and interest payable of 1.5 million. Interest cover is 5. $1.5 million. It's now it's just simple mathematics. Your PBIT is 7.5 million. Now there is no capital employed given. However, we are given with the asset turnover. We know the formula is sales divided by capital employed. Let's look at the example again. Apparently the formula is just beneath it. It's sales divided by capital employed, and we are looking for capital employed. Now we need an asset turnover and sales figure. We already know the revenue is 200 million and the asset turnover is 10 times. So we have got our required data. It's 10 times is equals to 200 million divided by capital employed. Again, it's just basic mathematics. Capital employed 200 million divided by 10. This goes there and that goes here, and we have our capital employed of 20 million. Now putting that in our formula of ROS, profit before interest tax was 7.5 million divided by 20 million. Our ROS is 37.5%. So that's our first example, and from this example you can very clearly see the level of difficulty the examiner puts in the exam. He will never give you a straight ratio so that you can just divide and multiply. He will also incorporate some level of difficulty. In some cases it can even go beyond this and tell you data of another company, tell you the data about another company, and tell you that the interest cover of this company which we are computing is 5 times the interest cover of that company, and you have to compute the interest cover of that company in order to come to the interest cover of this company. So this again he can put layers and layers if it wants. However, for now you can clearly see that this is the level of difficulty which in most cases the examiner uses in the exam. Moving on to our next example. Okay, now we have again a new extract. Now, as I just in the last video, I've told you that if an examiner wants a certain ratio being computed in a certain way, he or she will tell you. In this case, let's read out the example. Let's start with the example. Let's start with the example. The following is an extract of Henry's statement of financial position. We've got a total assets of 1000 million, share capital of 100 million, retained earnings of 400, total equity becomes 500, and we have got a loan notes of 500 as well, which becomes the total asset. Now, the ordinary shares are currently quoted at 5.50 and loan notes are traded at 125 over 100. What is Henry's financial gearing ratio? That is debt over equity, debt over debt plus equity using a market values. Now here the examiner specifically mentioned us that he wants debt over debt plus equity formula. So let's compute that. Now we have got a second. First we need to get the value of equity and debt in order to apply the formula. The formula which we will be applying is gearing is equals to debt over debt plus equity multiplying with 100. Now for this formula we need to get the market value of debt, market value of debt, and then the market value of equity as guided by the question. So the market value of debt, if we can get it from the question again, market value of firstly let's compute the market value of equity. The market value, the ordinary shares are currently valued at 5.50 and ordinary shares are $1 each. So it's simple as that. 5.50 multiplied by 100 will give us the answer for equity. This becomes $550 million, and the debt was, if I remember correct, that was 500 and was trading at 125 per 100 nominal. So that would be 125 over 100. Now if you compute that, we will get an answer of 625 million, and these are in dollars. Now putting the figures in our gearing formula, that is debt over debt plus equity, 625 plus 550 will give us 53%. Or this company Enrico is about 50% funded by the debt. The gearing has increased. That's the computation of example of Enrico example pertaining to the ratio of financial gearing. Moving on to our next example. This is relevant to operational gearing. Now here let's read out the example. A summary of HMCO's recent statement of profit or loss is given below. Revenue is 10,123. Cost of sales is 7,222, which gives us a gross profit of 2,901. Expenses are 999. Profit before interest and tax is 1902. Interest is 1000. Tax is 271, which gives us the profit of after interest and tax of 631. Now 70% of cost of sales and 10% of expenses are variable costs. Now, and the question now asks, what is HMCO's operational gearing? Firstly, the formula for operational gearing, which we will be using over here, is PBIT. Now, in order to take out the contribution, we all know the formula for contribution is revenue as variable cost. The revenue which is given in the statement is 10,123, and the cost is, which the question has guided, is 70% of cost of sales. 70% multiplied by cost of sales of 7,722. Also, it's 10% of other expenses, 999. Putting that, let's put this. Let's get some more space. Okay, we have now more space. Now computing all that, you will get an answer of 4967.70. And we all and from the extract you can easily compute the profit before interest and tax. All you need to do is add back the interest and taxation figure. If it's not given, if it's given, then it's fine. We are already given with the profit before interest and tax figure of 1902 over here. So let's put that also in our computation. We took the contribution now. Our contribution we have already computed, 4967.70 divided by profit before interest and tax figure of 1902, which is giving us 2.61. Now this ratio is in times, so it's in times. So that's the operational gearing MCQs. Pardon me, it's OT now. The level of difficulty has increased. Now these ratios, for examples, when we are doing it on lecture, seems very easy and straightforward. However, when you will be computing them or recomputing them, you will see that they are not quite straightforward, and like with everything, they require vigorous practice. So I always tell my students, never underestimate any exam of ACCA. They are tough to pass, and then are the privilege to pass them. So work hard. The next example that we are dealing with comes with the PE ratio. So let's look at that. It's on page number 9. PE ratios, we already computed PE ratio with the Henry co-extract in our last video. Now we are just solving the example over here. Our company has recently declared a dividend of 12 cents per share. The above share price is the share price is 3.72 cum dividend, that is cumulative of dividend, and earnings for the most recent year were 60 cents per share. What is the PE ratio? Firstly, the formula for PE ratio. Market value of share. Always remember that these are taken as ex dividend, which means the price which we are given in the example is cumulative dividend. We have to exclude that, and after that we need to divide it with an EPS. Now the market value 3.60. Let's confirm that. Yeah, it was 3.72. We have deducted 12 cents from it, that is 0.12, and now we are, and which gives us 3.60, and we are also provided with a 60 cents earnings per share. Now most students make this mistake. Do not make this mistake. 60 cents means 0.60. It's not 60. Most students, what they do is divide this by 60. Whenever we talk about cents, is always in points, and when we talk about dollars, is in straight numbers. So that becomes 6. That is our PE ratio for Enrico. The ex-dividend share price is used in this computation because it shows the underlying value of the share after the dividend has been paid. So that's the reason behind using the ex-dividend share price. Coming back to our notes and moving on to the examples. Now we have got our final example of total shareholders return. We all know the formula is the current dividend per share plus current share price plus previous share price divided by previous share price, which is divided by 100. The example over here pertaining to this is Henry Co's share price is 3.50 at the end of 2011, and this includes a capital gain of 0.75, including capital gain of 0.75 since the beginning of the period. A dividend of 0.25 has been declared for 2011. What is the shareholders return? Now let's compute that. Firstly, we need some space. We are now computing total shareholders return, that is dividend current share price as previous share price divided by previous share price multiplied by 100. We already read out the dividend, and the net share price was 0.75. Now in order to compute previous share price, we need to minus, we can read out again. You can see that current share periods, there has been share price is 3.50 at the end of June 1, and this includes the capital gain of 0.75 at the beginning of the period. Has been declared what is the shareholders return. So this makes us clear that we need to use 3 and deduct 0.75, which is the difference of current share price or previous share price, multiplying with 100, and the result is 36.4%. That's our total shareholders return, and that's our last example of chapter number 1. There are no more examples in this chapter. The chapter is now at the end, and thank you for watching.